Okay, let's dive in. You've probably seen the headlines. Goldman Sachs Q2 earnings just dropped. Big numbers.
Yeah, they certainly blew past expectations. For me, it wasn't just the overall revenue, impressive as it is, but that $3.72 billion in net earnings for the quarter.
Almost $8.5 billion year to date.
Exactly. And these figures really did smash what the analysts were predicting. It tells you, that the big players are active, confident, despite everything else going on.
So today we're going to unpack what's really behind these record numbers, the risks, what it means more broadly.
Let's get into the real story.
Absolutely. So big picture first. Net revenues, $14.58 billion for Q2 and nearly $30 billion, $29.65 billion to be precise, for the year so far. That's, well, a lot of money flowing through.
It is. And if you look at how profitable they were, the return on equity, the ROE, was 12.8% for the quarter.
Almost 15% for the half year, right?
Right. 14.8% annualized for the first half. And for anyone watching bank stocks, ROE is key. It shows how effectively they're using shareholder money.
Signals efficiency, good capital use, a definite green flag for investors, I'd say.
Totally. And adding to that, book value per share, basically the net asset value per share, that ticked up too.
Up 1.6% this quarter, hit almost $350. So, yeah, the foundations look pretty solid.
And the CEO, David Solomon, he pointed to, healthy client activity, their differentiated franchise, the team, standard stuff. But he also noted the economy and markets seem to be responding okay to policy shifts.
Which leads to the question, right? How much is just the market lifting all boats, and how much is specific to Goldman?
That's the million-dollar, or rather billion-dollar question.
Okay, so let's get into the engine room. Global banking and markets. That segment was a monster this quarter.
Absolutely. $10.12 billion in net revenues just from GBM. That's up 24% from last year. Huge.
And within that, equities really stood out.
Record numbers. $4.3 billion in revenue, up 36%. That's not just noise. That's significant institutional flow, both in trading like cash and derivatives.
That's the intermediation part.
Yeah, facilitating client trades. But also in equities financing, lending against portfolios, seems clients are really leveraging up or getting back into the market in a big way.
And advisory. I mean, wow. Revenues of $1.17 billion. That's a 71% jump. Are the deal makers officially back?
It certainly looks like M&A is heating up again, especially Americas and EMEA. And Goldman's right at the top, #1 in announced and completed M&A.
Still dominating.
Yeah. Top 2 in equity offerings, high-yield debt, the whole package. And importantly, their investment banking backlog, up again, 5th quarter in a row.
So good pipeline visibility, that's encouraging.
Definitely suggests more strong quarters potentially ahead for that division.
Even if ICC, fixed income, currency, commodities, that was up to 9%.
Yep, $3.47 billion, mostly driven by financing, things like mortgages and structured lending. So yeah, GBM was firing on pretty much all cylinders.
Okay, but it wasn't all smooth sailing across the entire firm, was it?
No, and that's where it gets interesting. If you look at asset and wealth management, net revenues were actually slightly down compared to last year, $3.78 billion.
Wait, but didn't their management fees go up by like 11%?
They did. Fees hit $2.81 billion, mostly because they have more assets under supervision, AUS. People are still putting money with Goldman.
So what dragged the overall number down then?
It came from their own investments. Equity investments and debt investments saw significantly lower net gains. Specifically, they mentioned some modest losses in their private portfolio.
Driven by real estate markdowns, I saw. Ouch.
Exactly. Management called it a challenging harvesting environment for those older principal investments. They're basically saying it's tough to sell those assets right now for a good price.
And they expect that to continue.
They signaled more muted results there for the rest of 2025. But on the flip side, total assets under supervision, new record, $3.29 trillion.
Wow. 30 straight quarters of inflows into their long-term fee-based products. So the core wealth business is still attracting clients.
Right. The underlying engine is strong, even if some of their own bets hit a snag.
Okay, then there's platform solutions. That's the newer tech-focused part, right? Including things like their credit card partnerships.
That's the one. Revenues there were actually up slightly year over year, $685 million.
But they lost money. A pre-tax loss of $57 million. How does that happen?
Credit losses. The provision for credit losses in that segment alone jumped 51%. It was $307 million.
So money set aside because they expect more people won't pay back their credit cards.
Precisely. It reflects actual net charge-offs loans they've given up on collecting and also expected future losses from growth in the card portfolio. It's a reminder that the consumer side carries different and currently rising risks.
And that pushed the firm-wide credit loss provision up too, right, to $384 million.
Yeah, primarily driven by those same credit card issues. So while GBM is booming, this part of the business is definitely facing headwinds.
Okay, shifting gears a bit. Beyond the divisions, what about strategic moves? I saw a big dividend increase.
Yeah, that caught my eye too. Up 33% to $4 per share per quarter starting next quarter. That's a pretty confident signal.
Tells you they feel good about future earnings, right?
Absolutely. And they backed it up by returning almost $4 billion to shareholders this quarter alone, share buybacks and dividends combined.
How do they manage that while still keeping regulators happy on the capital front?
Well, their key capital ratio, that Common Equity Tier 1 or CET1, is sitting at 14.5%. That's way above the 10.9% they expect to be required soon.
Gives them a lot of breathing room.
Exactly. And they said they plan to keep a buffer, maybe 0.5% to 1% above the minimums, just for flexibility, to support clients, grow the business, maybe more buybacks. They're also pushing for clearer capital rules, interestingly.
Another big strategic theme seems to be tech, especially AI.
Oh, definitely. They've rolled out this GS AI assistant internally, uses natural language, and they're piloting something called Devin to help write code faster.
So automating processes, boosting productivity.
That's the goal. Management sees it as a huge opportunity. It's not just about cost cutting, it's about potentially making their people more effective faster. A big bet on the future of finance work.
And it seems their focus on clients is paying off too. Ranking top 3 with 125 of their top 150 clients now.
Yeah, that's up significantly from 77 back in 2019. They put it down to changing how they're organized and how they cover clients. Deeper relationships, more business per client. You can see how that feeds into the strong GBM numbers.
Makes sense. But even with all this good news, Solomon's still talking about risk management.
As he should be. He specifically mentioned being very focused on it, acknowledging geopolitics, trade. Things rarely go smoothly. It's a necessary dose of caution, I think.
So let's talk valuation. The stock's trading around 2.5 times book value. That's quite a bit higher than its recent average, isn't it?
It is. The 5-year average is closer to 2.0x. It's definitely got a premium baked in right now. Some analysts are saying, maybe wait for a pullback to the 650, 675 range, which would be closer to that 2.0x multiple.
So for you listening, maybe be cautious about chasing it at these levels.
I think the advice is generally to focus on the quality parts, the high margin areas in asset management like private credit, alternatives, but maybe be wary of too much exposure tied directly to that consumer lending piece, given the platform solutions credit issues we talked about. Look under the hood, basically.
Okay, so wrapping this up, what's the main takeaway here? Goldman's Q2 shows they can really execute and make money when market conditions are favorable, especially in their core investment banking and trading businesses.
No doubt. They capitalize brilliantly. But you also see rising costs, those vulnerabilities in consumer credit, and some bumps in their own investment portfolio. It's not a perfectly clean picture.
And strategically, they're doubling down on those higher margin, less capital-intensive businesses, plus that big push into AI, trying to build a more durable earnings stream, perhaps.
Seems like it. But like Solomon himself said, developments rarely unfold in a straight line. Those challenges are real. The geopolitical backdrop is still uncertain.
Which leaves us with a question for you to think about. Given that premium valuation, how does a giant like Goldman balance pursuing growth, especially in areas like AI and private markets, while managing rising costs and those persistent risks, like consumer credit and global uncertainty?
And what does their journey balancing that traditional banking strength with newer diversified platforms tell us about where finance itself is heading? Is this the model for the future?
Lots to mull over. We hope you keep digging into these questions. Thanks for diving deep with us today.